The spot price looks calm, but the real silver market is getting louder by the day. And it's happening in the one place most people never check. Because right now you've got this weird, almost suspicious combination. A benchmark price that can stall and chop, while the cost to actually get metal in hand refuses to cool off. That contradiction is the story. And if you understand the mechanism behind it, you stop reacting to the noise and start watching the stress points that matter this week, especially the levels that can flip a boring consolidation into a forced move. Here's the setup in plain language. Silver has been ripping, then it starts to hesitate. You look at the chart and you think, okay, maybe it's tired. Maybe it's topping. Maybe it's just a headline trade and it's over. But then you go into the real world. Dealers, delivery quotes, premiums on coins and bars, the spread between what you see on a screen and what you pay. And it's not relaxing. It's not normalizing. It's staying sticky. And that's where the real pressure starts. Because premiums are the market's way of rationing metal without ringing a bell. If metal is abundant, competition drives those premiums down. If metal is easy to replace, delivery times shrink, spreads tighten, and everyone acts casual. But if the metal is hard to source, if wholesalers are cautious, if the pipeline is stressed, the premium becomes the pressure valve. Price can pretend to be calm. Premiums can't pretend forever. And I want you to keep one thought in your head the entire time. Spot is a reference number, not a truth serum. Spot can be pinned to you. Spot can be pushed around by flows. Spot can look stalled, even while the physical market is whispering something much more aggressive. But that's not the part that matters. The part that matters is what the market is paying for time. Because silver isn't just a price. It's a timing problem. It's a delivery problem. It's a financing problem. It's a logistics problem. And when those problems show up, they don't always show up first in the headline number. They show up in the spreads, the term structure, and the fine I'll pay up behavior from the people who actually need silver now, not in 3 months. So let's talk about the hidden detail that reframes everything. The spread is the headline, not the spot chart, not the influencer takes, not the daily candle. The spread, especially the nearby structure, tells you whether the market is paying a premium for immediacy. And that matters because in most commodities, the normal state of the world is contango. Future delivery costs a little more than right now because storage, insurance, and financing aren't free. That upward slope is the boring default. Backwardation is the opposite. It's the market saying, no, I want it now, and I'll pay more for now than later. In silver, when you see the front end of the curve invert, when nearby prices trade above deferred, your first reaction should not be excitement. Your first reaction should be respect, because that usually means somebody is scrambling for near-term supply, or the system is incentivizing metal to move quickly to where it's needed. And if this one level breaks, the math changes. Now, does backwardation guarantee a moonshot? No. Does it guarantee manipulation? Also no. But it does tell you the incentives are shifting. It tells you holding metal is being rewarded over holding paper promises. It tells you the market is willing to pay for urgency. And urgency is what turns a stall into a squeeze. Let us bring this back to what you actually feel as a retail investor or a physical buyer. You go to buy a 1-ounce product, a bar, a sovereign coin, whatever your flavor is, and you see spot is one number, but your checkout price is another. Sometimes the premium is a small nuisance. Sometimes it's the entire game. And in an environment where silver has been moving violently, like we've seen recently, premiums can do something sneaky. They can rise in dollar terms even if they look fine in percentage terms. That's an important psychological trap. Here's a quick calculation that snaps you out of headline thinking. Take the product you'd normally buy, note the all-in delivered price, subtract spot, that's your real premium in dollars. Now watch what happens when spot stalls. If spot goes sideways for a week and that premium doesn't compress, the market is telling you supply isn't catching up and the dealers don't feel pressure to discount. They feel pressure to protect inventory. That's the signal. And that's why the stall can be misleading. But why would spot stall at all if physical is tight? Because spot is dominated by paper market structure and hedging flows. Futures are where price discovery largely happens. Options are where pinning can happen. Margin is where forced selling or forced buying can happen. If you don't understand those mechanics, you'll keep thinking the chart is the truth, and you'll keep getting emotional whiplash. So let's do the mechanism explainer without turning this into a lecture. The simplest version goes like this. When you have a big options complex sitting around key strikes, market makers and dealers often hedge their exposure by buying or selling futures. That's delta hedging. As price moves, their hedge needs change. In certain zones, especially near large open interest strikes, those hedging flows can dampen movement. It can feel like price is magnetized. It can look like a stall. Now flip it. If price starts pushing through those zones, hedging flows can accelerate movement instead of dampening it. That's the reflexive part. In a market with thinning liquidity, like you often get around calendar events, those flows can create the kind of move that makes you think, where did that come from? It didn't come from nowhere. It came from math. And this move isn't emotion, it's math. That's why you can have a week where spot chops, headlines cool, and the average person relaxes, while the structural pressure quietly builds. Because if the curve is inverted, if near-term delivery is valued, if inventories are being treated like something precious instead of something plentiful, then the market is effectively storing stress. And now we get to the inventory trap, one of the most misunderstood pieces of the silver puzzle. People love to say, there's tons of silver in warehouses. Sometimes that's true, but the key question is not how much exists. The key question is, how much is deliverable at the margin right now into the system that sets the benchmark price? In exchange warehouse language, you can have metal that meets specs but isn't available for delivery. You can have metal that is eligible but not registered. Registered is deliverable. Eligible is basically, it could be deliverable if the owner decides. And that if matters. Because when the market is stressed, owners don't always volunteer their metal into the deliverable pool. They might prefer to sit tight. They might have it pledged. They might be waiting for a better price. They might not want the operational hassle. Or they might simply be thinking, why would I hand over optionality in a market that's getting tight? That's where the real pressure starts. Because a headline inventory number can look huge while deliverable supply is thin. And if deliverable supply gets thin at the same time, futures open interest is big, you get a classic tension. More paper claims than metal that's conveniently available. That doesn't mean default. It doesn't mean apocalypse. It means stress. And stress means the market starts paying for urgency through spreads and premiums. Now add a second layer. Silver supply is not like flipping a switch. A large chunk of global silver production is a byproduct of other mining, lead, zinc, copper. That means silver doesn't respond instantly to silver price. Even if silver screams higher, the miners can always ramp silver output quickly because their primary economics are tied to different metals. Then you've got refining bottlenecks. You've got fabrication lead times. You've got the fact that turning raw supply into the specific forms demanded, industrial bars, investment bars, coin blanks, doesn't happen overnight. Recycling helps, but recycling also has lags. It responds to price, yes, but it also depends on collection, processing capacity, and incentives across the chain. So the idea that tightness will vanish quickly is often a comforting myth, especially during a period of intense demand and high volatility. But here's the twist. The market can look tight in one area and loose in another. Retail can have weird pockets of oversupply, like when people sell old coins or junk silver into a spike. Meanwhile, the industrial and exchange ecosystem can still feel tight in the forms it actually needs. That divergence confuses people, and confusion is where bad decisions get made. You'll hear someone say, dealers are getting flooded with selling. You'll hear someone else say, exchanges are tight. Those can both be true, because not all silver is equally useful at the margin. A bag of old coins might not be what a refiner or industrial buyer wants right now. Large bars might trade at odd discounts if the pipeline can't absorb them quickly. Meanwhile, standardized deliverable bars in the right location, the right format, the right vault system, that's where scarcity can show up, even as other forms feel plentiful. Everyone's watching the headline, but the signal is somewhere else. Now bring in industrial demand, because this is where the metals crowd splits into two camps. One camp treats silver like a pure monetary metal, a levered gold. The other camp treats it like a strategic industrial input with monetary optionality. The truth is it's both, and that dual identity matters in a tight market. Industrial buyers don't care about your narrative. They care about continuity. If a manufacturer needs silver paste for solar, or components for electronics, or specialized applications that require silver's conductivity and properties, they don't get to wait for a dip if supply feels uncertain. Procurement changes behavior first and the chart catches up later. When risk rises, procurement shifts from just in time to just in case. They lock supply, they build buffers, they sign contracts. That demand doesn't always show up as a dramatic daily candle, but it shows up as persistent tightness in the chain. And in a market that's already volatile, that behavior becomes self-reinforcing. Because industrial demand is relatively price inelastic in the short run. If you need the input, you need it. The cost gets passed through or it gets eaten, but production can't simply stop. So the market starts leaning on investment flows to ration supply. And that is where the paper to physical tension becomes dangerous. In the finance sense, not the conspiracy sense. Let's talk about incentives, because that's the adult way to talk about suppression without turning your brain off. Futures markets exist partly so producers and consumers can hedge. That's healthy. But when you have big positions, when you have structured products, when you have options exposures, the system develops behaviors. Sometimes those behaviors keep price stable in the short term. Sometimes they amplify moves. Neither is evil. It's math plus risk management. If volatility spikes, margin requirements often rise. That matters because margin is the market's throttle. When margin jumps, leveraged players have to post more collateral or reduce exposure. That can create sudden selling even in a bullish story. Or it can create sudden buying if shorts are forced to cover into a move. And that's why silver can whip you around violently even when your thesis is right. So here's your psychology shield, and I want you to actually use it. In a high volatility silver market, you must separate trend signal from noise. Trend signal is structural, term structure, spreads, persistent premiums, sustained institutional inflows, inventory behavior, and the ability of price to hold above key levels after pullbacks. Noise is the daily headline, the 1 hour flush, the social media panic, the it's over tweet right before the next leg. The market will try to mug you emotionally. It will do it with gap risk. It will do it with overnight moves. It will do it with a brutal stop run into thin liquidity, and then it will rebound without you. That's not an accident. That's how crowded levered markets behave. Weak hands get shaken out, strong hands get inventory. And the next detail is to what flips the whole setup, the calendar. Because time matters in silver more than most people admit. The calendar is the catalyst. Around month end, funds rebalance. Around expiry windows, options dynamics shift. Around delivery periods, the appetite for near-term metal can spike. Around holidays and thin liquidity sessions, the market can move more on less volume. That wax why you can go from spot stalls to why did it jump $5 in a day? Without any new information. And there's another calendar angle people miss. When uncertainty rises, tariffs, trade frictions, policy shifts, geopolitical stress, physical metal can start migrating. It moves from one region to another. It moves from London-type pools to New York-type demand. It moves to where the marginal buyer is willing to pay for immediacy. That migration tightens some parts of the system and loosens others. It shows up in spreads. It shows up in availability. It shows up in the cost of carrying metal. Now let's layer in institutional flows, because this is the quiet behavior that turns loud. When big funds allocate to silver via trusts or ETP-style vehicles, they effectively take metal off the market. Not forever, not gone, but functionally removed from active circulation unless redeemed. When those holdings are rising, it's a persistent bid that doesn't care about intraday drama, it just absorbs. And when you combine that absorption with industrial demand and supply constraints, you get a market that can stay tight even when price pauses. That's a big deal, because retail tends to buy high and sell low, especially in volatile metals. Institutions often do the opposite. They buy structure. They buy when a thesis is confirmed. They buy when liquidity is available, and they don't flinch at a 7% pullback if the structural signals are intact. That's why you can see an environment where some retail is selling into strength while bigger pools of capital are accumulating. It's not moral, it's just different time horizons, and that's where the real pressure starts. So let's stack the proof points the way a skeptic would demand them, because one argument isn't enough in silver. You want a pile of clues that all point in the same direction. First clue, the term structure. If the front end is tight, if the curve is inverted or flirting with inversion, the market is paying for immediacy. That's not a vibe, that's a price. Second clue, the spot to real world gap. If the all-in cost of common physical products stays elevated relative to spot, and delivery times don't normalize, the chain is not relaxed. Third clue, institutional holdings behavior. If major silver vehicles are holding large inventories and flows are net positive over time, that's demand that isn't easily scared out by a headline. Fourth clue, the macro backdrop. When rates expectations, currency stress, or inflation expectations shift, silver can behave like a monetary asset with a turbocharger. Not always, but when it does, the moves can be fast. Fifth clue, market structure signals like margin and volatility regimes. When exchanges adjust margin requirements or when implied volatility spikes, the market is telling you participation is getting more expensive. That changes positioning. It creates forced behavior. Sixth clue, cross-market comparison and global pull. If one region is paying up or pulling metal, arbitrage links the system. It doesn't happen instantly, but it happens. Now, let's be brutally honest about the counterpoints, because credibility is everything in a market like this. Tightness can be real, and price can still drop hard. Demand can pause, liquidity can evaporate. A stronger dollar can hit metals. A risk-on shock can rotate capital away temporarily. A margin hike can force selling. And if a move has been extreme, you can get profit-taking that looks like a collapse, even if the bigger trend is intact. So how do you avoid being the person who gets emotionally harvested? You stop treating every red candle as new information. You treat it as a volatility event unless it breaks the structural tells. Here's the simplest two-scenario lens, and it keeps you sane. Scenario 1 is the controlled pullback and retest. Price dips, shakes people out, then holds key support zones. Premiums stay sticky. The curve stays tight. Holdings don't dump. That's a bullish retest. It's annoying. It feels like failure. But it's actually the market checking whether demand is real. And if it passes, the next leg can be cleaned. Scenario 2 is the continuation squeeze. Price doesn't give you the perfect dip. It gaps in thin liquidity. It rips through a key level, and dealers and hedgers have to chase. Spreads widen, volatility jumps. That's where the market punishes patience. It also punishes leverage. Because in a squeeze, you can get the move you want and still blow up if your risk is wrong. And that's not the part that matters. The part that matters is being positioned to survive either scenario. Now, let's translate all this into what to watch next, because that's what you came for. You don't need 10 indicators. You need a small checklist that tells you whether the thesis is strengthening or weakening over the next 1 to 2 weeks. Watch the premium behavior on the products that represent everyday demand. Not because you're day trading coins, but because it tells you whether supply is easing or stress is persisting. If spot stalls and premiums compress noticeably, that's a sign the chain is catching up. If spot stalls and premiums stay stubborn, the chain is still tight. Watch the front end of the futures curve. You don't need to become a curve trader. You just need to know whether the market is paying more for now than later. If that inversion fades quickly and the curve normalizes, that can be a sign stress is easing. If tightness persists, the market is still paying for immediacy. Watch volatility and margin chatter. If participation becomes more expensive, the market can get thinner. Thin markets move harder. That cuts both ways. It can create sharp drops. It can also create sharp squeezes. Volatility is a weapon that gets used against you. The market will try to make you panic at the bottom and chase at the top. Don't give it your steering wheel. Watch key technical levels, but use them the right way. Don't worship lines. Use them as risk points. A breakout that holds after a pullback is more important than a breakout that spikes and fails in the same day. A retest that holds tells you buyers are real. A breakdown that IS, accompanied by easing premiums and a relaxing curve, tells you the tightness narrative is fading. Because if this one level breaks, the math changes. And yes, I'm going to say the quiet part out loud. In this kind of silver tape, your biggest edge is not predicting the next dollar. Your biggest edge is not getting forced into a decision by volatility. If you can avoid panic selling into a flush and avoid leverage chasing into a spike, you're already ahead of most participants. Now let Uriel West talk about why this can matter even if you re-skeptical of the whole silver story. The reason is simple. Tight markets don't need everyone to believe. They just need enough people to need the thing. And silver sits in that uncomfortable intersection of industrial necessity and investment demand. When both lean the same direction, the market doesn't have to convince you. It just has to clear the price until supply shows up or demand backs off. And that's the conflict in your title. Supply tightens, even as spot stalls. The stall is the bait. The tightness is the hook. The premiums are the clue. The spreads are the mechanism. And the calendar is the accelerant. So what happens next week? You look for the market to test you. If silver has been ripping, the market will try to convince you it's over. It will do it with a sharp dip. It will do it with a nasty wick. It will do it with a scary headline. And then it will watch how price behaves at the retest zone. That's the moment. Because if price can pull back and still hold, and if the physical signals don't relax, you're not watching a top. You're watching a pressure cooker. On the other hand, if price starts losing key supports and the physical market relaxes at the same time, premiums compress, availability improves, the curve normalizes, that's your invalidation path. Not because the long-term story is dead forever, but because the near-term squeeze dynamics are deflating. The tape can change. Your job is to respond to signals, not to narratives. And if you want a concrete payoff for sticking through this whole breakdown, here it is. The next time you see silver stall, don't ask whether price is bored. Ask whether time is expensive. Ask whether immediacy is being bid. Ask whether the market is paying to get metal now. Because if it is, then the stall isn't safety. The stall is compression. And compression is where violent moves are born. One more thing before we land this. You don't have to be a maximalist to benefit from understanding the structure. You can be a skeptic. You can think silver is too volatile. You can think it's a trader's metal. Fine. But then you should care even more about spreads, premiums, and positioning, because those are the parts that explain why silver behaves like a calm lake one day and a hurricane the next. So here's your final clean roadmap, the identity piece, not the begging for clicks piece. The people who win in markets like this aren't the loudest bulls or the snarkiest bears. They're the ones who stay signal first. They watch structure, they respect volatility, they keep a two-scenario plan, they don't let the market bully them into panic, they don't let a green candle seduce them into leverage. They act like adults in a room full of adrenaline. If you're building that kind of mindset, you're already in the right community. And the next detail is what flips the whole setup. When the next pullback comes, you'll know exactly what to check before you decide it's over. Premium behavior, front-end tightness, liquidity conditions, and the levels that matter for confirmation versus invalidation. Because silver doesn't move when everyone agrees. It moves when the structure forces someone to act. And right now, the structure is flashing one message behind the calm spot print. The physical market is still bidding for urgency. And that's where the real pressure starts.